Today, volatility down to the wire. Halligan Martin North from Digital Finance Analytics, well, latest post covering finance and property news. This is our weekly market update where we start in the US, cross to Europe and Asia, and end in Australia, covering commodities and crypto along the way. And as always, this is a data-rich show. We have a lot to cover, including the upcoming US presidential election and the Federal Reserve's monetary policy meeting. These events are set to shake up the financial markets, so let's dive right in. First, the 5th of November vote. This election has captivated the nation and is causing significant swings in financial markets. The so-called Trump trade has seen a rise in the US dollar and a sell-off in Treasuries, fueled by strong economic data and a surge in Bitcoin, spurred by hopes that Trump would deregulate the crypto industry. But investors are on edge as polls remain deadlocked and bets leaning towards Trump are narrowing. Truth is, the polls are selective and partisan because they have to make assumptions about who might turn out to vote. In either scenario, there's some near-term risk, says Walter Todd, Chief Investment Officer at Greenwood Capital. A win by Trump could spark profit-taking in Trump trades, while a win by Harris could lead to a more serious unwinding. Investors are also wary of volatility from an election result that is not immediately clear due to the closeness of the race or is contested by one of the parties. Yesterday's market reaction was a wake-up call for the big events on our radar. Volatility is expected to rise further, and hedge funds have increased leverage in portfolios by 20.6% year to date, a trend that contrasts with positioning in the previous 3 US elections. Control of Congress will also be determined with Tuesday's vote, adding another layer of complexity for investors. The two candidates offer starkly different paths for the US economy. For example, Trump is expected to lower regulations and benefiting banks, while Harris is seen as more supportive of clean energy initiatives. Either way, government borrowing will continue to rise, one reason why yields are climbing again. Now let's talk about the Federal Reserve. Thursday's federal rate decision is another risk for the S&P 500's rally this year. The market expects a modest 25 basis point cut in the benchmark policy rate. Investors will be closely watching Fed Chair Jerome Powell's guidance, especially considering the strong economic data. The Federal Reserve's favorite gauge of inflation showed that core inflation remains steady at 2.7% instead of a decline to 2.6%. And the headline PCE index, which includes more volatile items like food and energy, eased to 2.1%, a spitting distance from the Fed's 2% policy goal. But the fact that the core PCE rose the most on a monthly basis since April, along with strong spending and robust growth data released earlier in the week, trimmed the Fed cut bets. The US 2-year yield rose to the highest level since early August, while the 10-year yield retested the 4.3% level to the upside. This week's data suggests the reasoning for a cut is still valid, said JP Morgan economist Michael Farley. Even if the election is decided by Thursday, there are enough uncertainties to warrant a cautious approach to forward guidance from the Fed. Citigroup's Economic Surprise Index, which measures how economic data performs versus expectations, is at its highest level since April. And data this week showed that the US economy grew at a solid 2.8% in the third quarter. But the US economy added a mere 12,000 jobs last month, with downward revisions to both August and September. Economists were expecting October's job additions to be around 100,000. The jobs miss was linked to the impact on hirings from 2 hurricanes that made landfall in the US last month, as well as a strike by tens of thousands of Boeing workers. Markets can likely park the October jobs report to the side, said Chima Shah, Chief Global Strategist at Principal Asset Management. Quite clearly, the hurricane has taken a heavy toll on the numbers, clouding the picture of labour market strength, and so should not impact the Fed's policy rate path. US stocks were higher after the close on Friday, led by gains in the consumer services, healthcare, and technology sectors. Amazon was up 6.2%, pacing a rebound in mega-cap techs, though Apple slipped on concerns about China sales. At the close in New York, the Dow Jones Industrial Average added 0.69%, while the S&P 500 added 0.14%, and the Nasdaq Composite climbed 0.8%. It was actually the first negative monthly performance for US indices since April, but equity bulls could try to take advantage of this weakness and prepare for the customary Santa rally into the year end. Remember, though, the benchmark S&P 500 is up over 20% year to date, while the Nasdaq rose 22%, and price earnings are extended. By the way, the Russell Caps was up 0.56%. The best performers of the session on the Dow Jones was Amazon, up 6.19%, and Boeing, up 3.54%. The worst performers were Verizon Communications, which fell 1.83%, while Apple declined 1.33%. The Volatility Index was down 5.53% to 2188. In other news, Intel will be replaced by Nvidia on the Dow Jones Industrial Average Index after a 25-year run. This underscores the shift in the chip-making market and marks another setback for Intel. Nvidia's shares have surged, driven by an essential role its chips play in powering generative AI technologies. Losing the status of Dow Jones inclusion would be another reputational blow for Intel, said Susanna Streeter, head of money and market at Hargreaves Lansdown. This could impact Intel's share price further. Meanwhile, gold continues to enjoy a 33% rally across 2024, its strongest yearly performance since 2007. Gold futures for December delivery were down 0.21% to 2,746.05 a troy ounce. Silver was at 32.58. Elsewhere in commodities trading, crude oil for delivery in December rose 0.32% to hit $69.34 a barrel, while the January Brent oil contract rose 0.34% to trade at $70.92 a barrel in reaction to the latest news on the wire, suggesting that Iran is preparing a response to Israel's latest attack. The yield on the US 10-year note was 10 basis points higher to 4.386, while the 2-year was also up to 4.212, which is a bit weird, but then bond investors are positioning for the Federal Reserve policy decision next week, the election, and 3 debt auctions. This may signal slower rate cuts ahead, though. The US dollar index futures was up 0.36% to 104.25. In Canada, the S&P TSX Composite gained 0.1% on Friday, with the best performers being Air Canada, which rose 13.99%, and Fairfax Financial Holdings, which was up 9.12%. The worst performers of the session were Centura Gold, which fell 7.52%, and Eldorado Gold, which was down 5.86%. And the VIX there was up 2.53% to 12.17. That's a new 1-month high. Now, we had seen a big equity sell-off in Europe and the US earlier in the week after Microsoft and Meta, which represents nearly 10% of the S&P 500 index, were hit by a 6% and 4% decline respectively. But European stock markets rose on Friday, helped by gains in the oil sector, while investors digested a disappointing US jobs report ahead of next week's presidential election and the Federal Reserve meeting. The DAX index in Germany traded 0.9% higher, the CAC 40 in France rose 0.7%, and the FTSE in London gained 0.8%. Reckitt Breska stock in London surged over 7% after the consumer goods group was cleared of liability in the latest preterm formula case. Siemens stocks rose over 1% after managing board member Cedric Nicky said that the German conglomerate has the financial muscle for further software acquisitions after its $10.6 billion purchase of US industrial software company Altair. Lufthansa lost 3% after HSBC downgraded the German airline stock to hold from buy, and UBS Group shares dropped 4.5% as investors focus on uncertainty about regulatory changes, the broader outlook, and how much spare capital the bank would have going into next year. The Pan-European Stock 600 index closed 1.1% higher after losing nearly 3% over the past 3 days, but still logged a weekly decline. And meanwhile, the Eurozone economy grew faster than expected last quarter, but the outlook was weak on threats of oversized tariffs from a potential Trump presidency in the US, escalating trade tensions with China, and muted consumer confidence. The stronger than expected Eurozone GDP and inflation data released this week, as well as some comments by ECB policymakers, poured some cold water on expectations that the ECB might accelerate the pace of easing, said Capital Economics senior European economists. However, by the December meeting, renewed economic weakness and well-behaved inflation will convince the ECB to cut the deposit rate by 50 basis points, they said. The ECB cut interest rates by 25 basis points earlier in the month, acknowledging slower inflation and a worsening economic outlook. UK markets reacted to the massive hike in borrowing contained in Chancellor Rachel Reeves' debut budget this week, as rules were redefined to enable more borrowing and steps were taken to address intergenerational wealth disparity by taxing the older more while lifting wages for the younger. Analysts feared the spending-heavy budget could put upward pressure on inflation and had investors betting that the Bank of England may have to slow the pace of future rate cuts. Two-year gilts surged 27 basis points so far, to the highest since May, although that seems tame compared to the 89 basis point rout that followed Liz Truss's 2022 effort. Investors will be watching if UK gilts extend their sell-off and whether the pound eases back. The pound was last at 1.292 against the US dollar. Asian markets started what promises to be a momentous month on the cautious side, with investors shunning risk assets ahead of Friday's US jobs data and next week's presidential election. The Nikkei 225 was down 2.79% and the Topix was down 1.9%, although both were higher across the week. Mitsubishi Electric Corp rose 14.18%, while Panasonic rose 8.52%, although Subaru declined 11.5% and Fujitsu was down 9.04%. The Nikkei Volatility was down 11.79% to 25.75. And the US dollar was up 0.31% to 152.98 against the Japanese yen. Chinese stocks were an outperformer, actually, with the Shanghai and CSI 300 both higher, while Hong Kong's Hang Seng Index was up 1.6% after a private survey showed that China's vast manufacturing sector returned to expansion in October. The Kexin S&P Global Manufacturing PMI for China rose to 50.3 in October from 49.3 the previous month and reinforced the upbeat findings that had been reported the day before in an official survey that suggests that the slowdown in the world's second largest economy may have troughed as a series of government stimulus measures begin to kick in to boost growth. China's manufacturing activity swung back to growth in October as an expansion in new orders led to a pickup in production growth, signaling improvement in the sector at the start of the final quarter. Markets will want more details on China's extra debt to revive the fragile economy as a persistent property market downturn and record low consumer confidence continues to drag on the recovery of the world's second biggest economy. China aims to step up supervision of government debt and plans to revise the law to do so, a spokesman for the Legislative Affairs Committee of the National People's Congress said on Friday. The changes proposed by the NPC Standing Committee will require annual progress reports on debt management work from the Cabinet and local governments. Last month, Finance Minister Lan Fao said China would significantly increase government debt and support consumers and the property sector, but gave no details of the scale or the timing of those fiscal measures. The Kospi was down 0.53% and the Indian Nifty was up 0.41%, but the VIX in India was higher. Australian shares closed at their lowest level in 7 weeks on Friday, tracking a broad sell-off in Wall Street, with banks leading the losses after Macquarie Group's earnings disappointed investors. The ASX 200 ended 0.5% lower to 8,118.8. It's fallen 1.1% over the past week in the second consecutive week of losses. The drop on the first day of November added to the index 1.3% fall in October. Of the 11 sectors, 9 ended in the red. Financials were battered, with Macquarie Group closing at a one-month low of $223.51 after tumbling 3.6%. The investment bank's profit for the first half of financial year 25 missed estimates, and its dividend was reduced. The big four banks receded as well, with National Australia Bank the worst hit, down 1.5% to $38.21. Energy was the biggest gainer, buoyed by a surge in oil prices on reports that Iran was preparing a retaliatory strike on Israel, possibly before the US presidential election on November the 5th. The rally sent Woodside up 1.1% to $24.05, while Santos added 0.7% to $6.83, and Ampol advanced 1.5% to $28.31. Materials also ended higher, responding to the manufacturing activity report from China. BHP rose 0.3% to $42.78. Rio Tinto bounced 1.7% to $121.33. And Fortescue was lifted 1.7% to $19.49. Meanwhile, iron ore price extended losses, with the benchmark December iron ore futures contract trading in Singapore down 0.6% to $103.05 a tonne. In corporate news, packaging giant Amcor slipped 4.3% to $16.01, even as it reaffirmed its fiscal 2025 outlook and declared a slightly higher quarterly dividend from a year ago. Mineral Resources climbed 3.1% to $40.61, adding to the 9.2% gain on Thursday's session after the miner struck a $1.1 billion deal to sell its oil and gas assets to Gina Rinehart's Hancock Prospecting. Building materials company Fletcher Building edged 0.7% higher to $2.74, despite the news that the New Zealand Commerce Commission was suing its Winston Wallboards unit for allegedly using rebates to secure supply deals. The Aussie was at 65.60 cents against the US dollar and 50.77 cents against the pound. The 2-year bond was at 4.069, having reacted to the hotter than expected inflation read ahead of the Melbourne Cup Day RBA rate decision. The 10-year was at 4.556 as expectations of rate cuts got pushed back out into 2025. Finally, Bitcoin was just below 70,000 US, having reached highs recently in the light of the US election. It was last at 69,594 and is still up 64.56% year to date. So, as we wrap up, let's keep an eye on the upcoming US presidential election and the Federal Reserve's monetary policy meeting next week. These events are set to bring volatility to the markets, so stay tuned for more updates. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.